Munch. He is a leading economist at the American Farm Bureau out in DC. He specializes in policy and federal milk market reform. He's a tireless advocate for America's dairy farmers. It's really interesting. He really is one of those guys that really cares what's happening with your milk track. It's not just a job, it's really like he has the passion. He wants you to get the biggest benefit you can, and he works towards that every day. He continues to shape national conversations on policy. He is outspoken to support you on what you're doing. And with that, we're honored to have Dan Munch, American Farm Bureau.
Thank you, Lori. And thank you all for joining this afternoon in sunny Wisconsin. Yeah, a little bit more on background. From the Northeast, went to University of Connecticut for undergrad, then Cornell University for grad school, focusing on dairy pricing and cooperative systems as well, and have been at Farm Bureau. This is going on my fifth year at Farm Bureau. So it's funny how much turnover happens in DC. Suddenly you become one of the longest serving people at one of these organizations. But in addition to dairy, also do specialty crops, transportation, disaster assistance, wildlife issues as well. So looking at a lot of different things that are impacting our farmers at the federal level, doing economic analysis and seeing how it's impacting our farmers' bottom lines. So for this presentation, I wanted to go broad, but then also zoom down to a lot of the topics that we're worried about today, thinking about some of the impacts we've seen of the federal milk marketing order changes, talking about some of the efforts that, if for some of you that attended the previous session with Greg Dowd and National Milk on dairy markets within the Trump administration, talk a little bit about policy changes that we've seen, other sort of dairy priorities that we have and we share with American Dairy Coalition as well. So the way I like to always start out my econ/policy presentations is to set the stage. USDA does 3 net farm income forecasts a year, where they basically forecast all of your cash receipts from crops and livestock, and they add in farm-related revenues, they add in government payments, and then they subtract all of your forecasted production expenses. They do one in February, they do one in September, they do one in December. So September 4th, we have our newest net farm income forecast, and you can see there, looks pretty good, right? $180 billion, that's pretty close to 2022, $182 billion where we had record net farm income. The problem there is that blue section, right? That's government payments as a percent of your net farm income. And you can see for 2025, it's close to a quarter of net farm income is expected to come from government payments. And when we look at what those government payments are for, they're for losses that farmers faced in previous years. So last year, $30 billion in disaster aid was provided to farmers through ECAP, Emergency Commodity Assistance Program for row crop producers, as well as $20 billion in natural disaster assistance for things like Hurricane Helene, Hurricane Milton, and a lot of other things that hit dairy producers in California as well. So it is a little bit misleading of a forecast when we say, oh, this looks pretty good this year for 2025, near record net farm income, when that $41 billion should be looked at filling in gaps that many farmers faced in prior years. And you might have heard this tale of two farm economies. One of my predecessors, Sean Newton, talks about this a lot, the tale of two farm economies that's happening right now. Because of the low beef supply, which has led to interest in things like beef on dairy, genetics, and those high prices leading into increased interest in that market. Livestock sector has tended to do a little bit better, and obviously this is going to be focused on dairy, but poultry, pork doing a little bit better off, some of that linked to the lower commodity prices, versus the blue, which is your row crop receipts, starting to separate from your livestock receipts. So we have generally decent conditions across the livestock sector versus row crop sector. We see massive losses per acre, and that's why you see a lot in the ag space right now ask for more economic assistance this year. And just this week, Trump officials talking about taking some of tariff money and providing it to U.S. farmers, and thinking about how that would work. So let's take a look at the earlier forecast from February on dairy and then compare it to the new forecast. So you can see this was from the February forecast. They thought cattle and calves was going to be about the same year over year in receipts, and then green everywhere else except for chicken and eggs. In their September forecast, everyone's going to be green except for dairy is going to go down a little bit. So the further demand pressures that we've seen for meat, consumers haven't really budged from buying beef. We're starting to see a little bit of that now. In addition to those supply constraints, boosted those expectations up, and now dairy products expected to see a slight decrease. So still up until recently, at Farm Bureau, we haven't been hearing from dairy farmers quite as much until the last 2 weeks because prices have been decently good, with some regional differences. But we're going to get into some of those other metrics as well. Part of the big story on the dairy space as well is dairy farmers are diversifying risk more, and they're using the beef industry to not only be reliant on milk markets, but also are buffering against some losses by, as I mentioned earlier, breeding with beef genetics. And this just shows the percentage, the colored sections are the percentage of the U.S. land area that's under different levels of drought, moderate drought, severe drought, extreme drought, exceptional drought. And then the red line is our cattle inventory. So you can see that lagged effect of, intense times of drought in the country, you start to liquidate your cattle herd, and then when the drought recedes, your cattle herd improves. We're at a point now, though, that there's been persistent enough drought conditions and demand on the sector that we're at the lowest cattle inventory in 75, 77 years, and that's why we have some of those record beef price conditions. And that's materialized as we've been emphasizing so much the past year or so in the dairy markets on the beef on dairy story. So the blue line being domestic beef semen sales, the vast majority of which end up being used in the dairy supply chain, and then your estimated beef on dairy calf crop growing up exponentially as well. So dairy farmers are able to put aside some of their heifers, generally, they're lower or older heifers, and breed beef genetics and take advantage of those higher beef prices. And, until recently, we thought, well, this is going to slow down some of that milk production increase, and it has to an extent. But now as we start to see milk production tick up even further, there is becoming a part of the story, well, are dairy farmers going to take even more of their heifers and breed beef to sort of prevent some of that? Or what do those metrics really look like? So obviously, tail of two farm economies, crop prices are going down, so average feed costs have been down when we look at the futures values. Now, one of the pieces that was just brought up in the previous session and that I just started hearing about is this issue with dairy margin coverage, especially if you're a dairy farmer who grows their own feed. You're not really being looped into the costs that you're using to grow your own food is not being reflected in this data, meaning that factored average feed costs might not be reflective of the actual margin you're facing. So that's something we are thinking about. It just came up, so what we ask at Farm Bureau is please engage from the farmer level and talk to your state Farm Bureau leaders about what you would like changes to DMC to look like, including American Dairy Coalition's engagement on that issue as well. But low feed costs, so margins has generally just looked better just from that, just margin over feed price. But we have seen production tick back up in the last quarter. Earlier in the year, January to March, production was down over 2024. April to June, we ticked up to record level production. So for a while there, we were thinking that production was going to sort of stabilize out, and with the beef on dairy side of things, more farmers using to breed with those genetics, it was going to buffer against those increases in production too much. But then combining with the increase in processing capacity we've seen and some of those demand draws, we've also, and people again getting better and better at raising cows that are great at producing milk, we have seen production per cow tick up. And that's reflected in quarterly milk production as well on total. Sorry, I might have not explained that thoroughly, but production per cow, quarterly national bulk production also at a record level. Dairy cow inventory. Earlier when I was just first giving a presentation on dairy updates in January of this year, I said, well, things look kind of on average with 2018-2022. Now we've surpassed the past few years and have a much stronger dairy cow inventory, again, contributing to that higher production number. Without that demand there, without that export demand there, which I'll get into all those dynamics too, going to be a downward impact on our prices. Weekly dairy cow slaughter, another metric that we like to utilize. That red bar earlier in the year coming in much lower than previous years, so lower slaughter, and people held on to more heifers and boosting up that number we just saw. Now we're more in line with 2024, and when we kind of put those metrics over each other, dairy cow slaughter as a percent of herd inventory, we're basically matching 2024, but lower than some of your prior years. So these are just all metrics that we look at on the economist team to just sort of track where things are going in the markets that ultimately lead to impact to y'all's prices. But there are some fascinating things happening out there in terms of our cheese product demand and our further processed product demands. I always like to look at these three metrics when I'm considering dairy product demand and where prices might go. And at the end of the day, they don't always match where prices actually go. And we kind of see this with butter more recently. But we have on our left over here, U.S. cheese exports continue to sort of steadily increase over time as that foreign request for U.S. cheese kind of holds strong. The blue line is your ending cold storage stocks, basically a metric that measures how much cheese is sitting in stores across the country and warehouses over 30 days. If that number starts to go down, that means you're eating into those cold storage stocks. You're using more than just what you're producing in that immediate time frame and dipping into your cold stores. We've seen that kind of be stable over time, and your domestic disappearance, which is how much your domestic market is consuming, also continues to tick up. So your international demand has remained strong. Your domestic demand has remained quite strong. Americans continuing to eat a lot of cheese. Pizza consumption, Taco Bell consumption, all that good stuff. And your cold storage has remained quite flat. And those are fairly good metrics in terms of price. When exports, domestic appearance start to stabilize or tick down, or that domestic storage starts to tick up, then you've really got a problem for your prices. And that's really simplifying things. There's a lot of more depending on what time frame you're in, that'll expose farmers to risk. This is looking at a 5-year time frame. But decent dynamics of demand in terms of the cheese market. What we have seen recently, though, is sort of a butter price collapse, right? Where we had, $3.17 per pound, now we're down under $2. And some of the same dynamics we've seen in cheese, we actually still see a lot of those dynamics in butter. So some of the conditions that are leading to this decrease are more nuanced. But butter demand, our exports of butter partially linked now to these lower costs and being more competitive on the global market. Those have skyrocketed recently. Dairy is one of those places, Greg Dowd mentioned it, where dairy exports have been quite strong in terms of the total conversation of ag exports. Our ending cold storage stocks are actually lower than they've been. So that's sort of a decent metric. And domestic disappearance continues to be quite strong. So one of the things that I think about is, dairy farmers in the U.S. continuing to get higher and higher butterfat content. And with these signals towards higher production and that cattle inventory we have, that's leading a lot of folks to think longer term and say, we're going into a market and globally additionally where you have a lot of milk supply out there. And that's one of the reasons why I think those butter prices have declined, but obviously leading into those lower milk prices that we've seen more recently. When we put all these class prices together, you could just see the mess of volatility our producers have had to deal with. Obviously, back in the 2020 era, that's when we were looking at all the formula discrepancies between the higher of, average of, and sort of how that volatility ended up in massive devaluing of pool values and negative PPDs for our producers. We had a great recovery in 2022 when you had some of those record milk prices. Decent stability between 23 and early 24, and now we're starting to come down again, and that's why I'm starting to hear more phone calls about dairy. So those are some of our underlying market metrics when we're thinking about what are some of the fundamental demand and supply characteristics. But you also have things happening on the policy side of things, right? Some of these were talked about. So let's shift a little bit to Farm Bill, a little bit to One Big Beautiful Bill Act, and some of the conversations related to dairy there. I always kind of show this chart, but Federal Farm Program and SNAP outlays, Supplemental Nutrition Assistance Program. These are programs that are generally within the Farm Bill each time it's authorized. Spending dating back to 1970. The dark blue is nutrition spending. So you can see that since 1975, the dark blue has made up the vast majority of Farm Bill spending, which is that Supplemental Nutrition Assistance Program. The One Big Beautiful Bill Act, you all might have heard, made some revisions to the SNAP program that lowered estimated forecasts for that spending. Some worker requirements that they expect will minimize some of the benefits folks will receive under that program. So if I had this chart here previous to the One Big Beautiful Bill Act, 82% of the Farm Bill would have been made up of SNAP spending for the next 10 years. That's been brought down to 72%. And the difference is that orange gap, so $186 billion over 10 years, removed from SNAP and then invested into the farm programs. But you will see, and even adjusted for inflation, COVID pandemic happened, right? And there was a lot of demand on these nutrition programs to support people that were out of the job. That receded. Jobs sort of came back, the economy recovered, but that program still remained extraordinarily expensive. It adjusted with inflation, while farm programs did not. Triggers within ARC PLC and some of the updates within dairy margin coverage as well. So just some of the dynamics in place with Farm Bill spending. But us and other ag groups work together to get changes within the One Big Beautiful Bill Act, including an extension of dairy margin coverage, ARC PLC, our main commodity support programs, including enhancements to different disaster assistance programs. Not like a massive dairy issue, but now if one of your animals gets killed by wildlife, you get 100% compensation versus 75%. That's a big issue with wolves out west. More trade investment, that's super important for dairy and was mentioned in the previous panel. A lot more animal health investments, and I'll go through some of these as well. But over 10 years, a $66 billion investment in agriculture from the One Big Beautiful Bill Act. It didn't renew all pieces of the Farm Bill that are important to us. They mentioned the Permanent Price Authority, where you could have those massive dairy payments come into place January 1st. Those parity prices was back in the 1940s. Which would be between $50 and $60 a hundredweight. The government would basically have to buy enough dairy to boost up those prices to those levels. They still have to relieve that, pass legislation that relieves that before the end of the year. That was not included in this. But some dairy wins in there. So this was mentioned, dairy margin coverage, and they're not all inclusive fixes to the program, but this was a Farm Bureau priority, and I also believe American Dairy Coalition, but updating production history from 2011, 12, 13, now you can use 2021, 2022, or 2023, and then it updates every 5 years with the new Farm Bill that you can adjust that production. So if you add new cows over that period, you can be better reflected in your dairy margin coverage payments. There's also, you have those more affordable, you have two tiers within dairy margin coverage. The tier one is more affordable. That's been lifted from 5 million pounds to 6 million pounds. So we're getting a little bit closer to the average of 8.5 million pounds for a farm. And then they extended the option for producers to receive an additional 25% discount if they enroll in dairy margin coverage for the duration of the Farm Bill, so through 2031, which is substantial savings on premiums for people who do that. Now, obviously, again, this was part of the discussion in the previous panel. When you have lower commodity prices, the program's not going to trigger. And it might not reflect, if you're growing your own feed, for example, higher intensive alfalfa operations, it's not going to trigger. So the last 17 months or so, every green bar is a month that dairy margin coverage did not trigger for producers. Though, back in July 23, we had record low margins, and it's the first time the catastrophic coverage levels in dairy margin coverage were triggered. So one thing that I always like to remind folks is, just because it's not functioning now doesn't mean the program's not working right in terms of providing payments. There was a point in time where this program kept a lot of dairy farmers in business, and it's great to have conversations on how to enhance it. But I still think it's a no-brainer program, and something to continue talking about is how can we make it better reflect market conditions? Because we are lucky as the dairy industry to have one of the first margin programs that exists out there that offers this sort of protection. What else was in the One Big Beautiful Bill Act that will give us a direct leeway into the federal milk marketing order conversations that a lot of you might be here today to talk about? The bill directed USDA to conduct a mandatory biennial cost survey of dairy processors. That was something we've been asking for, especially at Farm Bureau, American Dairy Coalition, National Milk Producers Federation, even IDFA, all supported this sort of collection. Now, we don't know when USDA is going to start collecting. They have to put out a rule on how that will look. Biennial, it would happen every 2 years. And and I'll get into this more, but USDA would still have to hold another hearing to use those numbers. And that's something that folks need to realize. Even though USDA is now authorized to collect this mandatory cost and yield data from processors, you would have to initiate another federal milk marketing order hearing for them to use that data in any new make allowances. So for those of you, not too familiar with the topic, I'll get into it. But that's an important piece as well. And there's also, as I mentioned, animal health preparedness investments, disaster assistance updates, tax provisions, export promotion funding. So I always like to zoom out, and I know some of you have seen some of these slides, but I think that giving everybody a little bit of, Federal Milk Marketing Order 101 again is super helpful. You have our 11 federal milk marketing orders around the country. Each of these regions has distinct marketing and production characteristics. I kind of want you to keep this map in the back of your brain because it's going to become important in future slides. One of the ways I think about these differences in production, think about Florida. Got a lot of people, not a lot of cows. So a lot higher fluid milk demand. Most of that milk is going to be immediately put into those fluid milk markets in places like Tampa, Miami, versus a place like Wisconsin in the upper Midwest order. Not as many people, a lot of cows. You can put a lot more of that milk into manufactured products that last longer. So those sort of characteristics create these differences in regions that each have their own federal milk marketing order regulations, but then you have at the regional level, and then you have stuff that applies to all these orders at the national level as well. And I know some of you have seen these slides as well, but what does the federal order system do? I used AI, which still doesn't know how federal milk marketing order pricing works. ChatGPT still can't steal my job. Made this little a graphic to explain it again. But USDA regulates generally three things. It's not only setting minimum pricing for farmers, which is the main one that we're talking about, but also timely payments for farmers ensures that you get paid at least 2 times a month. That's something that would go away if the federal system did not exist, and that is very important to farmers. Like, what if your contract then became 90 days? So that's something we're always thinking about. Providing third-party verification to make sure that you're being tested, that you're being paid on your components correctly is also included in the federal order system. So yes, minimum prices is what we always talk about, but those two other things are very important services that the federal order system provides in those regions as well. How do they set a minimum price? And this will lead right into our make allowance conversations. They work backwards, right? So USDA goes out and they survey all the different end products, cheese, whey, non-fat dry milk, butter, out in the marketplace. How much is being sold and at what price? So they have this end product price, and then they work backward to derive the value of fluid milk that's being used in those products. So little Zippy here is buying this milk to produce the cheese. USDA is surveying how much the cheese is being sold for and at what volume, and then USDA is trying to figure out, using formulas that they set through this process, how much the fluid milk is worth. Okay, so if the USDA is using end product prices from these surveys to set a minimum price, it costs little Zippy here something to convert the fluid milk into cheese, right? He has labor, he has non-dairy ingredients, he has overhead costs. That costs something, and it has to be subtracted in order to take what the value of the fluid milk actually is. So that cost, that number, to convert fluid milk into those further processed ingredients is called the make allowance, the allowance to make. And that's where there's a lot of concern that, we went through this whole federal milk marketing order hearing process. That's where there's been disagreements between processor groups, cooperatives, dairy farmers. The disagreements aren't about make allowances existing, right? The way that the formula is set up, you need something that accounts for it since you're starting with that end product price. It's how they came up with the prices. It's a very political process, right? USDA people testify in the hearing from all different stakeholders, all different perspectives. They provide testimony to USDA. USDA takes all that testimony and they pick something, and then they put it in a rule, and then farmers have to approve that rule. In the testimony, and this is just one example, and I know I've shown this chart a number of times, but they use data from processors where 76% of cheddar cheese plants, 80% of butter plants, 40% of non-fat dry milk plants, 71% of dry whey plants did not did not participate in the surveys used to show their processing costs. So that is what our concern is. You have the vast majority of processors not participating in a survey contributing to what USDA ended up using as their final number for a make allowance. So the number could be skewed farly too high. You have the implication that your most efficient plants don't really have the incentive to participate, right? If I'm a very large, efficient plant, brand new, why would I want to provide my cost data that might be looped into the final make allowance selection that USDA makes? That's just going to negatively impact me. That's why our farmers have concern. They want trust in the system. They want transparent prices. They want to know how much it's costing folks to convert their dairy product, their fluid milk, into dairy products. And if that number is too high, that's artificially decreasing that dairy prices that dairy farmers receive. That's the concern. Now, we got a lot of pushback from folks that, well, processing costs have increased, which is obviously it's increased for our farmers as well. Production costs increase, energy costs increase, labor costs increase. That is true. But in the case of dairy, we have had over $8 billion in investments from banks and investors in dairy processing for between 2023 and 2026, well before the federal milk marketing order hearing knew to be underway or was officially underway. That construction in a lot of cases was already taking place. So a hard pill for our farmers, and I get calls on this all the time, to swallow, is that extremely higher making allowances were needed to fund infrastructure improvements when those were already happening without the higher make allowances. So that's something that our farmers ask us a lot, and it's sometimes hard for us to give them an answer. So obviously, there's on the other side of this issue, processors argue, well, we removed premiums from farmers' milk checks over time to help sustain what the make allowances haven't been able to make up. And I can't wait for all the farmers to tell me when their premiums come back from their processors. Please let me know when they come back, because I'm waiting for that data. Has it come back? Has your marketing and competitive premiums come back yet? Anybody? No. Okay. Just curious. I know it's only been 3 months, but so most of the changes in the federal milk marketing order system, except for one, which one of the ones that benefits farmers, went into effect on June 1st. So we've had 3 months of data come out from USDA. There is a delay. That's why I don't have September data for all of these changes. But the main changes, you had make allowance increases, you had class 1 differential increases, which generally farmers cooperatives supported. You had you removed barrel cheese from the protein price formula. You switched back to the higher of class 1 formula. I'll touch on a little bit of each of these, and then increase the composition factors. On the make allowance piece, which I was just discussing, you had your current make allowances per pound and your final, so you can see the difference per pound increase. And what I did is it's just a simple static analysis that I did in previous times to look at what make allowances, what we expect make allowances, the changes to impact on farmers, but I put them in the actual numbers that we've seen for the past 3 months. So over June, July, and August, in that analysis, negative 89 cents per hundredweight class 1, 85 cents off class 2, 92 cents off class 3, and class 4 85 cents off under the new make allowance increases. And those are right in line with some of the averages that I had previously in looking at between 2023 and 2024 prices as well. So not unexpected that this would be the range of impact, just looking at notwithstanding any of our other market conditions, just comparing one factor in the equation to another factor in the equation. When you loop in the amount of pooled milk for those 3 months on each of those orders, a loss of $337 million in the pool just from the make allowance increase. Now, I will get into it. The class 1 differentials offset that a little bit, but a pretty big impact, especially on the upper Midwest, California, which aren't going to be offset with those class 1 benefits as much. So pretty substantial. That's basically 1/4 of the year, $300 million out of the pool. Multiply that by 4. You can put that together in your brain. That's a substantial impact on dairy farmers' pool value. Now, to zoom back out to AFBF policy a little bit, we now have this survey authorized, which we don't have a timeline on it. We don't really know what it's going to look like, but it will be authorized. One of the problems is, Well, like I mentioned, once we get the data, we need another hearing. And then what do we do with it, right? What if it shows us, high efficiency processors, low efficiency processors? What do we do with that information? At the AFBF level, I will just flag for folks that our farmers voted on this new policy that those should reflect the cost of efficient new plants producing commodity cheese in the U.S. Their thought process, and folks might disagree, processors always argued during the testimony process of the hearing that it's a minimum price that farmers are receiving. So our farmers say then it should be a minimum make allowance in the calculation. That's only fair. And they understand that there are processors with higher costs, but if that's the expectation of farmers, it should also be the expectation of processors, is what our members believed. So that's sort of the make allowance story, and I'll touch on it a little bit more. Something that dairy farmers, including AFBF, asked for is a switch back to the higher of. You had the average of switch in 2018 Farm Bill, where you took the average of the Class 3 skim milk price with the Class 4 skim milk price, and then you added a differential. We just wanted to go back to the higher of, where you just took the higher of those two items, no 74 cents adjuster that they added on that average of. Simplifies a little bit in the mind of producers, and during times of high volatility, when the 74 cents adjuster didn't protect dairy farmers, it gives farmers that volatility cushion. Now, they also threw in this other piece, which I haven't talked about yet, the extended shelf life milk adjuster, which I always like to read this because we went from asking for more simplification to adding something new, and that new thing is the rolling average of the differences between the higher of and the average of the advanced Class 3 and Class 4 skim milk pricing factors over the prior 13 to 36 months. So now we have the Class 1 price that we wanted to make more simple, and then instead we just added, okay, well, if it's an extended shelf life milk product by definition of USDA, then now you do this little bonus calculation, and that 10% of milk has this adjuster on it. And in all fairness, to date, that adjuster has been positive, between 85 cents and a dollar something. I have it in my analysis if people are interested, but per hundredweight, an additional for that extended shelf life milk. And that does add more value into the Class 1 pool. So it has benefited farmers, but it's still confusing and adds a little bit more, people, I have been told that it's concerning that it's like a fifth class of milk that's not necessarily fully factored into how the federal order system was meant to function. Obviously, you can spend hours on a day figuring out arguing about that as well. So the switchback hasn't been, what I will preface this with is that the main reason that our farmers wanted to switch back to higher of was during times of volatility, it is generally preferable to the average of. And over a long period of time, the net impact will be more neutral. But in times where you have that volatility, large spread between Class 3 and 4 prices, it will behave better. So to date, you've had a wish-wash impact from the change. The higher of would have the average of would have been higher in June and July, but it's been the average of would have been higher in June and July, but it was lower in August and September. So the higher of was preferable in August and September. So a little bit, and you can see a little bit more negative so far. A little bit more negative so far, and I think I missed one of my slides. Oops. Well, I'll grab one. It's online, but I also had a Class 1 differential, which basically the Class 1 differentials were increased across the United States as well, and that increases the pool value depending on how much Class 1 utilization you have in each of your orders. So what this chart is showing is if you net out the higher of class change with the Class 1 differential increase, what would that impact to that $337 million number that I looked at the impact of make allowances be? So dividing that up, it's still $231 million impact with those changes. The remaining change, and because the barrel price was removed from the survey, that was not contributed to this as well, but would boost up upper Midwest and California and those higher manufactured price regions a little bit more as well, but only marginally based on some of the previous analyses that we've done. But the last change, the composition factors, the federal order system assumes an amount of protein, other solids, non-fat solids in milk. Dairy farmers have been great at increasing those levels. And basically USDA, the formulas that were set were underpaying farmers for the components of their milk. They upped those a little bit, not directly in line, depending on what region you're in, with actuality to those new percentages. And you can see the expectation impact to farmers' prices. An increase of 50 cents for class 1, 32 cents for class 2, 57 cents for class 3, 32 cents for class 4. Over a year, $200 million benefit to farmers on average. But they delayed the implementation of composition factor increases. So dairy farmers aren't seeing any of those benefits and won't until December 1st. And the reason USDA claimed was for risk management concerns, or people who might have had outstanding contracts that might be impacted by these changes, which our folks were confused with, because then why would you put make allowances to effect right away as well? But differences there. This was just looking at my 1 year impact from previous years. And again, the differences that we see across the different federal milk marketing orders, with Upper Midwest and California hurting the most because of the impact of the make allowances, your higher class 1 utilization areas faring more better. So far, it's been a little bit more extreme than this is showing, with your green bars a little bit lower and your red bars a little bit lower. So that's sort of our make allowance federal milk marketing order situation. Again, mixed. Our dairy farmers are concerned with the make allowance increases. There's a lot of hope with the survey, and hoping that they get more adequate and fair data. That's really what our dairy farmers are looking for: transparency in how their prices are being set. So we are looking forward to USDA putting out how that will look. All right, let's talk a little bit about trade. It's very important to the story, very important to how milk checks look across the United States. The trade story for dairy so far this year has looked pretty good, and Greg Dowd has alluded to that earlier today. But all ag trade at the bottom had a deficit about $20 billion. We've imported $20 billion, $70 billion, and exported only about $50 billion. And this was back, I think, January to April. I need to update it. Versus dairy trade has a surplus of about $1 billion those months, and has continued to increase. The main area where we see that deficit is in horticulture products and tropical products, where we don't really produce a lot of those in the United States. But dairy exports continue to be strong. Where are our top 10 dairy export markets? Number 1, Mexico, 30% of our market. Canada, 14.9%. That was brought up a little bit, in the earlier session. And then number 3, this is China. Yeah, I was like, I was looking at South Korea, and I'm like, why is my South Korea label over China? But no, number 3, China, 7.1%. And obviously those 3 countries, some of the biggest 3 countries to be locked up in all these tariff conversation and trade conversations, but 74% of our dairy exports going to these top 10 markets. And you can see that, continuing generally positive increase in our dairy exports over the years, with Mexico remaining that largest chunk. But it really depends on what product we're looking at, how much each of these trade situations will impact our farmers, and the regionality of where our milk is transformed into further processed goods. So you can see, we do export a substantial amount of cheese and butter, but it's only about 8% of our total cheese production and 4.4% of our total butter production, with the largest amount of cheese going to Mexico, South Korea, Japan, butter, most of that going to Canada, Mexico, South Korea. When we go to the more co-product side of things, powders, whey, non-fat dry milk, that dynamic shifts. Most of that is going overseas. Americans not really using those in products consumed here as much, but lactose, for instance, 25% going to China, 85% in total of U.S. lactose going overseas, 75% of non-fat dry milk, 68.5% of whey. And we look at these co-products, that subsidizes, in effect, our prices for other dairy products here, right? When we get rid of these powdered goods that are produced when we produce cheese and butter, and we're pushing them overseas, and they have value overseas, we then have that lower price effect in the U.S. because now they can sell that cheese for a lower price in the United States because of that offset of the production process. So those dynamics are an important piece of discussion as well. has been in the news. Agricultural trade with China starting to drop off and continue to expect to drop off. But we had that peak of $38 billion of exports in 2022 with that Phase 1 China agreement, and that's expected to decline in 2026. ERS forecasts to $9 billion. We've already seen some of that in the dairy industry. I took this one from Terrain, but U.S. share of China's whey imports fell to 27% in June of this year when we used to make up around 40%. So starting to see the impact of that. You also have, some of the rhetoric around trade with the administration starting to filter into our agricultural markets. This is not dairy, but I think it puts into the perspective. We had that interesting question come up in the prior panel about Canada. The Canadians got really mad at us after the rhetoric around the Trump administration around them. And for instance, they stopped buying our wine. This is monthly wine exports to Canada. You can just see basically dropped to nothing this year. And that's just not dairy, obviously, but just an example of how rhetoric has led the population of a country to not like to purchase our goods as much anymore. And a developed country like Canada, which like the U.S. has the ability to choose what food products they're buying in the grocery stores, that has a real impact on our farmers in the United States. Now, to zoom out a little bit again, because some of these are more longer term looking considerations, but they do feed into the dairy story as well. A lot of folks don't remember how big Brazil is. When you overlap Brazil over the United States, it would reach from Edmonton, Canada, down to Mexico City. Their corn grain producing region, their main state, Mato Grosso, is about, I think the metric is 6 of Illinois. And it can produce 2 to 3 crops a year, because you have to remember they're in a warmer climate. So we used to take for granted in the United States that everybody had to come up to us for our grain. We have great infrastructure. We're the lowest cost producer, yada, yada, yada. That's not true anymore. They've gotten tons of investments from other countries like China. They're improving their highway infrastructure. They're getting investments in their port infrastructure. They can produce 2 to 3 times our Midwest once they reach that threshold, and are paying labor $4.20 an hour. So this is a major thing we're thinking about in the longer term. How do we compete with a nation like Brazil? Obviously, there's more risk and uncertainty still in their geopolitics, in their infrastructure, but longer term, how does that look? And we've seen it in our grain markets, and it's starting to show up in some of our specialty crop markets as well. But the black line is the export share of the United States, what it used to be and where it is now. We used to supply 45% of the world's corn exports. Now it's 31%. 60% of soybean exports, now 28%. 71% of cotton, now down to 44%. So just something to think about within the broader ag industry. If we are not competitive with these other nations, and this is for dairy too, where we can continue to see growth in those markets as well, even though the U.S. remains the best and most efficient producer of dairy and other livestock products. If other countries catch up, that becomes an issue for our dairy farmers. I'm going to skip some of those. But an exact example of this infrastructure piece and a problem that I see in the United States that we have to think about, and you guys were just all talking about labor, which plays into this as well. Countries with seaports ranked in the top 50 for efficiency. U.S. isn't even lit up, has not one port in the top 50 in the world for efficiency. Who does have ports in the top 50 for efficiency? Oman, Vietnam, Sri Lanka, Indonesia. Developing countries you would not think about having efficient ports that are able to supply the demand, consistency, reliability that importers are looking for in their supply chain. Yes, it might not look like it directly impacts dairy, but that supply chain interconnectedness is extraordinarily important for importers as well. And until our infrastructure improves, these other countries that are lit up here are going to have that structural advantage. Where do our ports show up? Well, a lot of them are in the bottom. Tacoma, 401. This is out of 405, by the way. Tacoma, Oakland, Savannah, Los Angeles, Long Beach. Our Pacific Coast ports, which are our major export ports for dairy, rank in the very bottom of ports around the world for efficiency. Our top one in the United States being Charleston, South Carolina. So this is a problem we're watching. We know the administration, the Trump administration and the Biden administration, both have been concerned about shipbuilding and infrastructure. And there was the Chinese shipping fees issue that happened as well. The problem is we have no infrastructure in the United States to produce ships at the rate that South Korea, Japan, China do. And it would take years and years of investment for us to get that infrastructure. You also have unions that have anti-automation language in their contract. It is built into the union's contract that ports cannot use automation. That's what they agreed to when they sign on to these union contracts when they go on strike every few years, right? That happened last year. And you only get very incremental increases in flexibility on automation. So something else we're thinking about, but in long term will impact our export competitiveness. All right, so let's just talk about a few more things, and then we'll open it up to questions. So at Farm Bureau, we have our policy process. We had a number of Farm Bill priorities. Obviously, we cover all commodities, so it's not just dairy, but there were a few priorities remaining that didn't get put in the One Big Beautiful Bill Act. A couple of them are related to federal milk marketing orders. We don't think there's going to be congressional appetite for them right now just because we're not going through a hearing process. But modified block voting remains something that we want to achieve. Right now, cooperatives can block vote on behalf of all their members, meaning that if you are an individual dairy farmer, you do not have the right to independently vote the way you want to if you want to vote separately. We had a little bit of steam there with, a cooperative was going to join us and then sort of lost steam, but we are still looking forward to that. If dairy farmers want their cooperative to vote on their behalf, they can still do that under this metric. But modified block voting being one, termination of an order under a no vote. So in January of this year, some of you in the room may have voted on the federal order to vote to adopt the changes or to reject the changes. In most cases, your cooperative probably did it. But the problem is, if you voted no and the 2/3 vote was no for the volume of milk produced and the number of producers, then the federal order would go away. It terminates the federal order. You're basically saying the order doesn't work how it existed and won't work with these changes. Delete it. Which would remove a couple of other benefits that I mentioned: timely payments, third-party verification, that is so important to many of our farmers, in addition to the minimum pricing regulations. So we have policy that supports removing no vote, removing a federal order. Again, those two items, we don't think there's going to be a lot of congressional support for right now, just because a hearing's not taking place. The two that we think there might actually be some movement on and support for, if we can get our ducks in a row. Whole milk is kind of happening on its own because everybody in the ag space is really on the same page there, and with the Maha focus from RFK and his support of whole milk, we think that's going to move on its own. But milk check transparency is really something that we want to look at. Where did the concern come up? Well, obviously at Farm Bureau we get a lot of calls, and I know other groups in the room get a lot of calls from their members when something doesn't look right on their milk check. And when you are regulated under a government system, you as a farmer want to trust that what you're being paid and the terms on your milk check are consistent with the regulations under that federal and government system. But the fact of the matter is we have heard many reports of handlers using words that seem like they're related to a regulated federal minimum, like market adjustment, or putting a dollar figure that might not be truthful under a producer price differential. Using those numbers that a farmer looks and reads and says, oh, this is the government regulation, but is actually the handler retaining earnings in some sort of way. Removing retained earnings, right, to a cooperative, right, to fund those business decisions, which as a farmer-governed organization they can do, but doing it in a way that hides it on the milk check. That's the concern. Now, there is some milk check transparency requirements on the book, but it's for proprietary handlers. And I've learned we have some milk checks that have been submitted to us that not all proprietary handlers are even following the milk check requirements. And when they initiated conversation with the market administrator, nothing happened. They talked to each other for a little bit, but there's no enforcement. So if you are out there and your proprietary handler is not following this breakdown of what's supposed to be required on a milk check, please, let your Farm Bureau know. Please let your market administrator know. This is supposed to be enforced. What Farm Bureau wants, and I know what American Dairy Coalition wants, is we want this minimum requirements for cooperative handlers as well. So because they're viewed as a farmer, just like with the minimum pricing regulations, they sort of are exempted from this, but they move over 70% of the milk market in the country. They should be able to abide by the same mandatory disclosures, as you can see here, as proprietary handlers. So making sure that's enforced. We tried to do this through the hearing process. USDA told us it didn't fit the scope. So now we can either do it through Congress or through notice of public comment. And we're trying to figure out where we want to stand with those, and we'll continue to have conversations with our partners. But it's something that we're thinking closely about. So requirements for proprietary handlers that were listed on that last page, and you can go through it, but should be extended to cooperative handlers. It's section 73E or F, depending on what order you're in, of the regulations. And that would better allow farmers to see the link between their actual pay price and the regulated minimum. They should be able to see everything that the federal government minimum payments were set, all those pieces, and what they were paid. That's all that farmers are asking for. They want to see what all the regulations are, and then what they're being paid for cooperatives and for proprietary handlers. Also adding things on the amount of milk pooled or depooled, so they can see whether or not their handler depooled in that month and what percentage of their milk was part of that. Because as you might remember during the COVID process, if your milk is depooled, it's not part of the minimum system, the federal minimum pricing system anymore. If they depool their milk, they don't have to pay part of that anymore. They're not part of the order system anymore, which happens a lot in the upper Midwest. So including that on there as well, so that dairy farmers know why their price might be lower than their peers. That's a piece. And then provides clear comparisons and milk checked line item minimums. So I know that's a lot to sort of think about on the top of your head, but one of the things that we're asking for is, folks that, whether you're involved with the American Dairy Coalition, whether you're involved with your local farm bureau, if you have examples of milk checks that you're like, okay, there's some funky business going on here, or you're just confused, or you want to show something, redact all your personal information on it and share it with folks. Because if there is a problem, like we're being told at AFBF, we want the evidence to show that problem so we can get Congress on board with it. Because at the end of the day, we think it's a reasonable thing to ask for milk check transparency, and especially farmer-owned organizations should be on board with that. So that's one of our big asks now across our two organizations is, if you have examples and evidence of this, please let us know. And then, how much time do I got? I forgot I had this other little section. But whole milk in schools, we almost did it last year, and then the previous chairwoman blocked it. But we think we'll get it done this year. But I will just flag a couple of things about it. Total U.S. sales of all fluid milk continue to decline. The last bar, 2025, is just January to July, but we continue to see fluid milk sales decline. These are all fluid milk products. Now, whole milk sales have increased, and we're starting to see, such emphasis from influencers on nutrition and exercise people. When I used to go to the gym, I never used to see milkshakes with people, and now I see Fairlife everywhere and other sorts of products that have these high protein values into it, and they're generally whole milk or blends of whole milk in it. So that's starting to tick up, and we know that we see the evidence of when whole milk was removed from schools, we saw a drop off of consumption and more milk being thrown out. And we're starting to see that recovery. The yellow line is low fat milk, 1%. Fat free milk is the light blue. Skim milk sales. Whole milk is the darker blue line up top, and then the gray line is reduced fat milk, 2%. So whole milk surpassed 2% sales back in 2019, and switching that offering in schools will hopefully bring back and improve on that increase in demand. And then the last thing I'll touch about, we're still waiting for FDA to put out their final guidance on labeling of non-dairy products with dairy terms. They released a guidance, when was it now? Early last year, that said that non-dairy products can use dairy terms, and if you want to, you can put on a nutritional equivalency statement that it's not nutritional in the dairy, but you don't have to. So basically the exact opposite of what current FDA standards of identity imply, where you can't even use these terms on dairy products. And we commented and a number of organizations in opposition to that, and just follow existing FDA guidance. So don't know if that's at top of mind this year, but with the MAHA focus as well, this could come back into the loop as part of that puzzle and part of the way that the administration tries to, they're talking about ultra-processed foods. Are they counting that? Who knows? But that's the last sort of update we've heard about dairy. So I know I talked about a lot. I talk fast, sometimes get lost in my own head. But all these analyses that we talked about, in addition to all of the analyses our econ team does on all these other issues on all markets, are available on our Market Intel website. If you scan the QR code and then scroll down a little bit, there's a spot you can put your email in, and they'll go to your email, or you can just check out some of our previous intels. All the charts on the federal milk marketing order impacts are on our most recent federal order impact analysis. That includes the green one that I was leaving out on class 1 differentials. But just to summarize, remember to be engaged. I really emphasize what Greg Dowd said. Be simple and tell the problem like you're telling it to a toddler when you're interacting with a public official, because they really do not know what you're talking, especially milk. Like the amount of people that when you tell them that whole milk is 3.5% fat, and they were like, that's all it is, because they think whole milk is like 70% fat or something. You're like, I thought it was just, no. What's the rest of it? It's 2% milk. I thought it was 2% milk. What's the rest of it? Yeah, the amount of conversations I've had on that. But have good engagement with your public officials. Tell the whole story. If you have milk check examples, please provide them to any of us in the room that are willing to advance this issue. But thanks for your time, and happy to answer any questions. Pete?
Danny, thank you for a heck of a wide range of information and insight. Thank you. So, I have a couple yes/no questions.
Okay.
In light of the shutdown, are we going to have manufacturing class prices for September?
I heard yes.
Will the National Dairy Products
Yes.
support or price data be out on a regular basis?
I heard yes on that.
Okay, no production?
That was a maybe.
Dairy market news?
That was a maybe too.
Cold storage?
Also up in the air. I think the last three are far more unlikely than the other ones.
Thank you.
Yeah. I think yeah. I got a thumbs up in the back there too. Other questions? Okay.
Let's take on make allowance for a second. In long-term unintended consequences, what if you're wrong?
Yeah, I mean, it's a good question, right? I think the feeling, the way that I like to put it, and obviously, right, I'm representing the American Farm Bureau organization, which has their specific policy on make allowances, which I don't think it's unreasonable to ask for transparency in make allowances, and they've been increased. So the question becomes, what if farmers are going out of business day to day, that are taking each day one at a time, versus large processors that are thinking 10 years in the future? That's often the conversations that I'm having. Is these make allowance changes are impacting my bottom line as a dairy farmer today, when the decisions being made by the co-op are 10 years in the future, which I know is not always how we want to think about the dairy industry. And we're thinking about the dairy industry's success in 10 years as well. We know that's important to dairy farmers, but a lot of farmers are looking day to day as well. But in addition to that, I think it goes back to the story. How do they answer the question of the amount of investment that's happened in processing capacity without the increase in make allowances? That's the story I keep being told by dairy farmers, that they have never been able to get an answer from processors on. Why is the make allowance needed, especially when you can, move your balancing around to even places when you're a large co-op that are unregulated? Why are you able to use that as a way to reduce the price for the farmer when you've been able to increase processing capacity anyway? So it's nuanced, because part of it's, we could get this data and it could show that the prices have increased, and even for high efficiency, it's higher than we thought it would be. We could get it, but the fact that we've had processors across the board during the testimony who would not provide their data seems to imply that that's not true. Why would, if processors' costs increase at the levels that they're saying they increased, then every processor should have provided voluntary data through the hearing process. And we did not see that. We saw numerous processors withhold that information. You saw that the slide there as well, and I know I'm kind of rambling at this point. But you have this lack of confidence within dairy farmers. They just want trust in how the system works. That trust has not been provided them up to this point. If the survey shows that the costs have gone up, I think our dairy farmers are okay with that. But also understanding that, minimum prices for dairy farmers, as they claim, should also mean minimum processing costs for processors. That was a very convoluted answer. That had a number of thoughts in my head, but yeah.
So you talked about processing capacity. What is the actual net change of all of this new processing capacity? So we're adding all this new capacity. What about plant closures or plants being taken offline? What is our ultimate net change?
Yeah, it's a good question. I don't have the number for you off the top of my head. It's a good one that I should have for that question. Regionally, I have heard generally it's increases in demand for milk. I mean, most of the cows are going to larger farms with lower costs. I mean, I think I just saw an announcement with 25,000 dairy cow operation in Massachusetts, which is kind of unheard of in the New England area. But all I'm hearing is that they're adding new cows and they're even adding new farms and shifting the amount of cows they have in different regions to sustain new processing plants. So like the Fairlife plant, Chobani plant, they're adding new cows in New York than they've had before. So depending where you are in the country, there is some probably areas where you have plants being closed and less demand. But on average, I think that the processing capacity has increased. And we've seen that in the amount of production that we've seen in the country as well as exports.
Thanks, Danny. And thanks, everyone. That ends our afternoon sessions. There's some snacks in the back, coffee. So feel free to stay. Danny will be around for a little bit if you have any other questions. And thank you to our sponsors, Prairie Farms, RP Nutrients, and Cargill. We really appreciate